Index funds like the Schwab US Dividend Equity ETF, known as SCHD, have become more and more popular as they are sort of a one-stop vehicle to financial freedom. But when it comes to the SCHD ETF, I think it's time to address the elephant in the room. And although this video is going to be sort of critical against the king of all dividend growth ETFs, I want to be very clear that I'm very bullish on SCHD in the longer term, and as of filming this video, I currently own around 400 shares of the ETF. On top of that, with full intention to keep buying more and more shares as time goes on. Now, if you hold SCHD or plan on it, you're going to want to stick around until the end of this video because we have something very important to talk about. But before we dig into all that, please drop a like down below and subscribe for more investing videos like this. So getting right into it, the SCHD ETF tracks the Dow Jones US Dividend 100 Index, which is made up of around 100 different stocks. Now this index has clearly performed well historically with an annualized 10-year return of around 11.1%. Now the aspect of SCHD that we have to be honest about and dig a little bit deeper in this video is going to be the underlying index that SCHD ETF tracks, which happens to be none other than the Dow Jones US Dividend 100 Index, and figure out exactly why this index is underperforming the market by so much as of lately, and if or if not this index is going to continue to be a disaster like it's been as of the last year moving forward. Now, to explain things a little bit more clearly for everyone, every index fund has a benchmark or an underlying market segment or index whose performance it's attempting to match. Investors need to know how to evaluate the benchmark to determine whether or not it's likely to meet their investment goals. Now, SCHD, as we stated, is looking to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. And although a lot of you guys are probably familiar with the Dow Jones Industrial Average, we're not talking about that one here. We're talking about the US Dividend 100 Index. Now, the Dow Jones US Dividend 100 Index is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. So far this index sounds pretty good, and the fact that SCHD tracks it before fees and expenses makes it seem somewhat of a dividend growth investor's dream. And although historically during lots of different time frames it has been, as of recently over the last year or so, it's been far from perfect. So we need to take a few steps and dig a little bit deeper to figure out exactly how the fund selects its stocks within this overall index. So that brings us right here into the Dow Jones US Dividend 100 Index methodology. This will tell us exactly how stocks are added or maybe not added into this index and figure out what the heck is going on and why so many of the stocks that have been added as of recently have sort of been a dud. So it first says index universe. The index universe is defined as the constituents of the Dow Jones US Broad Stock Market Index excluding REITs. So no REITs are going to be in here. It then says stocks must pass the following screens. And this has been historically one of my favorite aspects about SCHD, the fact that it's so tough to enter into the underlying index because it does have to pass multiple different screens, which sort of weeds out a lot of the lower performers, or at least has historically. So screening number 1, it has to have a minimum of 10 consecutive years of dividend payments. Number 2, minimum FMC of US $500 million. Number 3, minimum of 3-month ADVT of US $2 million. Stocks passing all 3 screens are ranked in descending order by IAD yield, defined as a stock's IAD, not including any special dividends, divided by its price. The top half of the securities based on its rankings are eligible for stock selection. The reference data for dividend payment history is the last business day of December, while FMC and ADVT are as the last business day in February. Now the index construction is as follows. Number 1, the eligible securities are ranked by each of the 4 fundamental base characteristics. Things like free cash flow to total debt, annual net cash flow from operating activities divided by the total debt. Companies with 0 total debt are ranked first. Return on equity, annual net income divided by total shareholders' equity. IAD yield and 5-year dividend growth rate as defined as this formula right here. Number 2, it says the 4 ranking are to create a composite score, and the eligible securities are ranked based on the composite score. Now the top 100 ranked stocks by the composite score are selected to the index subject to a following buffer rules that favor current constituents during the annual review, which are the constituent stocks will remain in the index as long as they are among the top 200 ranking by the composite scores. Next, non-constituent stocks are added to the index based on their rankings until the constituent count reaches 100. And next, if 2 non-constituents have the same composite score, the non-constituent with the higher dividend yield will be selected. So overall, the methodology of how stocks enter or of course exit the Dow Jones US Dividend 100 Index seems to be very straightforward, and also seems to pretty much cross off everything that dividend growth investors would be concerned about for investors to have exposure to high quality stocks. But now heading over to the SCHD website, let's look through some of the top holdings as far as percent of asset total and get an idea of what kind of stocks, what kind of companies we're talking about. So number one, the biggest holding as of right now is currently Amgen Inc. Number two is AbbVie, Pepsi, Merck, Chevron, Coca-Cola, Verizon, Texas Instruments, Pfizer, and Broadcom. Now these 10 different stocks make up a large amount of the entire holdings. And keep in mind, this holding breakdown is going to be an outcome of the underlying Dow Jones US Dividend 100 Index methodology. So through that methodology, through all different screening, the biggest portion of ETF right now is things like industrials, healthcare, financials. These are the top 3 sectors as of right now. Next comes things like consumer staples, information technology, energy, consumers, discretionary, communication services, materials, and a little bit of utilities. Now, because of the different stocks within the SCHD ETF's holdings, this ETF has performed horribly over the last year to date, down around 5.5% as of filming this video. And keep in mind, I'm not trying to be dramatic here, but this is during the same time frame where the S&P 500 is up around 13% year to date. And I'm by no means saying that the SCHD ETF has to outperform the S&P 500 or even necessarily perform close to what it does on a consistent basis. But if you were to look at the performance of SCHD and the S&P 500 year to date, we're talking about a delta of almost 20%. Now, this is of course due to things like the performance of some of the top holdings in the ETF. If we look at Amgen, for example, year to date, this stock is up around 2%, which at least it is in the green. But another popular name that makes up a decent amount of the overall ETF, which is down 9.45% year to date. Not to mention there's other stocks that make up the top 10 holdings that are an absolute utter disaster this year. Verizon's down 17.35%. And maybe let's not even get started with Pfizer, down 35.66% year to date. So the question that a lot of SCHD investors have, and for good reason, is if the overall methodology of the underlying index that SCHD tracks is or is not going to continue to perform horribly for future years to come. And because of the strict rules of SCHD ETF and the methodology of the underlying index, it's not like SCHD has the ability to completely shift around the portfolio on a daily basis, considering this fund is rather passively managed. But one thing that's very positive to look forward to for all the SCHD investors out there, including myself, is the up and coming reconstitution that happens once a year, where we are definitely going to see some of these different names, some of these different stocks taken out of the ETF, taken out of the index, and we're of course going to see some new names join it. But the bigger question still remains is if or if not you as an SCHD ETF holder want to actually have exposure to the companies that make up the underlying index. Companies like Verizon, companies like 3M, and companies like Pfizer. There's tons of companies in here that are really underperforming, and of course there's also different stocks in here that are performing quite well. But just for the sake of this video, we're sort of playing devil's advocate and trying to really point out some of the bad performing aspects of SCHD ETF. Investors are really going to have to ask themselves if or if not this ETF is worth holding on to long term. Now for me specifically, like I talked about during the beginning of the video, I still am adding more shares of SCHD, and I think the overall ETF and index that it tracks is just having a downtime, and I am very bullish and hopeful for future reconstitutions and adding different names that are really going to make the ETF flourish in the years to come. But now I want to hear from you guys down below when it comes to the SCHD ETF, the underlying index that it tracks and the methodology that it uses. Do you think SCHD has what it takes to turn around in the future, or is this ETF going to be a disaster from here on out? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.